Okay, guys, so it's 2 after, so we're gonna go ahead and get started, and we'll just keep letting people in as we go. So we are so excited about doing this. This is a first ever collaboration between Movement, True Homes, and Brian Pate Seminars. So I'm gonna ask everybody to mute yourselves if you could, and then you can always unmute yourselves when we do questions and answers. So I'm going to go ahead and share my screen and get started, guys. So let's see here. All righty. So can everybody see my screen? Perfect. Cool.
Good, Nicole.
Awesome. Thank you, Arielle. Arielle is going to be watching the chat box for us. So guys, this is, like I said, a first ever annual, hopefully, event between Brian Pate Seminars, Movement, specifically Alex and Melissa, and me and Arielle at True Homes. Me and Arielle have been doing this for a little while, where we get perspectives from our executives every year at the end of the year, and all the data from the previous year and what they're thinking is going to happen moving forward, plans that we're making as a new construction company, developer, where we're going to buy land, how we're going to price houses, why we're doing it that way. And they share those perspectives with us specifically so that we can be knowledgeable and share them with you, and you can share them with your clients. This is ultimately going to be hugely impactful to our real estate market, because new construction sets the tone in a big portion of the market right now. So congratulations to everybody who decided to join. You're going to have an absolutely amazing time. Okay, so let's go over the agenda. So very first thing, if everybody could remember to mute, that would be great.
Just telling that.
Nicole, you should be able to mute everyone on your controls at the top right.
Participants.
Should say mute participants.
Yep. Mute all. Okay. All right. There we go. All right. So first we're doing our introduction. Then me and Arielle are going to get started, guys, on doing the new construction perspective. Next, Melissa and Alex are going to do the mortgage and financing update. And then Brian's going to round it out with real estate market trends. Now, this is going to be very interactive, so pay attention. We're also going to have a contest, so this is going to be huge. So at the very end, we will have a wrap up and questions. But because it's going to be so interactive, we do want you to take advantage of the chat box. And like I said, Arielle's going to be watching that. Jump in, Arielle, because I can't see that. If anybody has a question that you want to go ahead and address. And at the very end, we'll have that question time frame. So let's go ahead and let you know about our contest here. I apologize, it's just moving on forward. Okay, so raffle, sign up. So everybody needs to scan this QR code. We are going to do a $50 Amazon gift card giveaway. And that is going to be for specifically posting on social media about this seminar during the seminar. So as Brian always likes to do, I stole this idea from Brian, during his classes, take a picture, say thank you please to Movement and Brian Pate Seminars. This is huge. We're very excited to have them with us this time. When you do that, make sure you tag all of us. And I will show you this code again at the end, and 2 times you're going to have our Instagram tags. So just be aware that contest is going on. It's an awesome opportunity, and you can let everybody know how good you are about educating yourself. So let's go back to the tags right there. So everybody take note of that. I'm going to give you a minute. Take a picture. We'll come back to it later. And we're going to move on from there. Okay, so the new construction perspective with me and Arielle. So just a little bit about us so that you know that we know what we're talking about. Between the two of us, one of us, Arielle, when she was still single, as a single unit last year, got top sales volume in the entire company. This is huge because she was selling mostly out of Lillington. And a lot of this was knowing market data. And if that's a surprise for you, then it won't be after today. So also between the two of us, we have the top number of core brokers right now. So if you don't know what a core broker is, we will go over that a little bit later. But this is a very special partnership that we have with agents, and you would know if you are one. And sometimes you get special invitations to different events. You get special incentives for your clients. So this is a really huge program. It's what we base our entire business off of. So we will circle back around to this one, but the point here is we know what we're doing. I don't mean to be cocky, but we really put a lot of effort into this market data, and that helps translate to sales and relationships. All righty. So I put a little bit in here that Brian's going to go over. So we're going to go over at a very high level. And guys, we are going to move through these slides very quickly. And this is going to be an interactive slide. So talking about demand versus supply, we're going to do a on this hand, on the other hand, before we jump into all of the data about where the market is and where we think it's going. So first in the chat box, go ahead and put in there for me, how many more buyers you think are going to hit the market nationally over the next year. So these are new buyers. And then Arielle, if you could call out some of the answers that are going in the chat box, that would be great. This is gonna be rapid fire, guys, because we're gonna move through it. Anybody put anything in the chat box?
Not yet. No one wants the first one. 2.8 million says Chad. Million says Becky. Definitely more with interest rates going down 30% more than last year. That's some of the answers we've gotten so far.
Next, before we move on to that, on the other hand, what do you think is the change? And this is where Melissa and Alex are going to jump in later, but what do you think is the change from January to October in the purchase price on an average $1,800-ish a month payment? So pop in what you think the difference is, how much it changed.
For total purchase price.
Total purchase price.
What could your clients afford in October of 2022 for $1,800 per month versus what can they afford total purchase price in January of 2023 at $1,800?
2022.
Yeah.
So January 2022.
Chad says it went down $60,000.
All right, that's a good one.
Want to be brave?
Nobody wants to take a guess? Okay. All right. So what I want to show you then is this right here. Love this graphic, you guys. These are generational groups by 10 years. And a couple of these generational groups span more than a 10-year period. We know that. But this is the population. And so you can see the population has just skyrocketed. Also, unfortunately, we do have people who, phase out. So this is just showing you how many people are turning 65 in the next year. Also, how many people are going to be entering the workforce next year. What's really important about this is just looking at the fact that we have got the same number of people turning 65 as the same number of people entering the workforce. And there's about double the number of people coming behind them compared to the people that would then be kind of phasing out, maybe going into different living situations, putting their homes on the market. So this is a severe supply constraint issue. There's about 78 million people over the next 18 years coming onto the market or being able to come onto the market by entering the workforce after this next year. And you can see they're not going to be the same number that could potentially be doing resale homes. All righty. And so this one right here is the monthly payment. This is really interesting. It struck me hugely. So what this is saying is January 2022, a household could afford a $400,000 home at a $1,784 monthly payment. This is based on her first-time home buyer data, and this is going to be obviously based on data the lenders can get into a little bit more. What's really impactful here is the change that we saw from January to October. We went to a $274,000 home for the same monthly payment. So that's why you're seeing some of the behavior that you saw last year. That's the why behind the what. And I'll let the lenders and Brian go into more about that. All righty. So the next slide here is going to be about our market specifically. So this is the other hand. That's one hand. We're in a severe supply constrained market, even as you see numbers go up, and Brian will talk about that. This chart right here, basically what happens is you want to be on the left-hand side of the chart. That's where your market is doing well. The right-hand side of the chart, you are starting to lose people. People are leaving your market. And so if you take a look the national and where Raleigh and Charlotte are, and even, you know, you might see the Triad in there somewhere, but where those markets are completely different. So again, Brian's going to go over headlines versus reality and micro dynamics a little bit more, but just know that this is a really good way to visualize the strength of our market that we're in right now. Oh, let's go back. All righty, so I'm going to let Arielle go now and talk about timeframes and supply chain.
Yeah, so
I know interactive portion here as well.
For sure. So in 2020 and 2021, and even into 2022 a bit, you know, you were working with clients who were doing new construction and you were seeing timeframes get extremely stretched out, supply chain being a huge issue, not being able to get windows or lumber or any of the key things that you need to move along in the construction process. So luckily, those items are starting to normalize. What you're going to start seeing is builder timeframes shorten back to kind of a standard, I would say 6 to 12 months for more of your you know, national builders. It's going to still be around probably 1 to 2 years for your more, you know, your more custom builders, and having supply chain issues normalize a bit. So what's your estimate of the change in the average build time from 2018 to 2021? Sorry, I kind of gave it away a little bit.
Well, it's interesting. We're going to look at the data.
Yeah, feel free. What's your estimate of the change for the average build time?
A number of months in there. Let's stick with kind of production numbers. Those are the easy ones to guess. So what do you think is the difference in the number of months between 2018 and 2021? Any answers?
Nothing yet.
Okay.
6 doubled, 3 months, up 4 months, 18 months.
Nice. Okay. So interestingly, on the right-hand side, this data is from the US Census. This is measured in months, and this is going to be rentals, built for sale, contractor built, and owner built. Interestingly, we started to go down in 2020 from 2019. And then as Arielle mentioned, we really started getting hit with all of our supply chain constraints and demand, and that started to stretch out again. I think what's really impactful about this one is the perception, right? People did have situations where overall they went a lot longer, but in general, year over year over year, we have been kind of staying in the same range from 2018 to 2021. Some builders have gotten really, really good at managing this. So it's just an interesting fact to be aware of, is that it's all about perception. And we're kind of in a zone now that I would say probably on average with true homes, you're looking at 6 to 9 months in 2020, late 2022 and into 2023. And then you're going to have other builders that are taking a little bit longer. That's all about how they manage their business. Do you want to talk about the chart on the left, Arielle?
Yeah, sure. So this chart was actually a survey that was done to builders talking about the supply bottlenecks and asking, okay, each month throughout 2021 to 2022 timeframe, do you feel like the supply chain is getting worse? Is it getting better, or is it staying the same? And you can see the end of 2021 through even the beginning springtime of 2022, a lot of builders were reporting it's getting worse, this is really challenging, or it's not getting any better. But you can see towards the summertime of 2022, and I believe as you continue through 2022 into 2023, all of those reports are getting better. We're seeing a lot less pressure on that side of the business.
Now, Brian will talk a little bit more about perspectives about how stuff can change in the future, but that is what we are experiencing currently. All right. All right, so I'm going to let Arielle take this one as well. It's a very interesting piece of data.
Yeah, so in the news lately, the past couple of years, we've seen a lot to do with cancellation rates. And so on the right-hand side, these are the top national builders. These are all publicly held builders, so they are required to report these numbers. But you can see even the between 2021 and 2022, the national builders cancellation rates have gone way up. And even at the bottom there was a national builder that just reported that they saw a 68% cancellation rate in the last quarter of 2022. So this is really huge. And you might say, okay, so why are all these clients canceling? Is new construction still a good option for my clients? And it is, as long as you understand why this has happened. So one thing that happened, obviously, is the interest rates increased significantly. Now, what we always talk about, and this is regardless of True Homes or national builders, clients have the opportunity to lock their rate. So if they chose not to, or for whatever reason, we're told that they shouldn't, and all of a sudden, like we saw in the data previously, their $1,800 a month payment went from that to $2,500 a month. That is a huge difference that a lot of clients weren't prepared for and weren't comfortable with. So that had a lot to do with the cancellation rate. Also, going into market uncertainty, people have, we've started seeing some layoffs here and there. Maybe people just aren't as comfortable with the market. So they thought, okay, maybe this new house isn't quite right for me at this time. And then we also saw a lot of panic buying and people kind of cooling off from that and kind of going, oh my gosh, I'm about to buy this house and I don't know if this is really the right solution for me. So cancellation rates, that'll be interesting to keep your finger on the pulse. There's a lot of stuff in the headlines right now about that. But it all comes down to setting proper expectations and working with a builder who is going to be delivering the product that your client wants in a timely manner and at the price that they are expecting.
Having that information, I'd be very curious to know, what do you guys think is True Homes' targeted cancellation rate? So pop that into the chat box for me if you could.
0, 0.
We would love that, but we have to be somewhat realistic.
Yeah. 8%, 10%, 5%, 3%.
Oh, this makes my heart sing because this is all like amazing. We try not to cancel your clients' contracts as much as we absolutely can. And I think Melissa and Alex can speak to that, and all the late nights that they have saved stuff. Melissa getting everything clear to close on one of my deals in literally like 3 or 4 days. Like, it was insane. Not to set her up for expectations of that in the future, but that was fantastic. Our expected rate is 25%.
And that's what most builders are going to be looking at.
We don't hit that. So obviously we try. But when you're looking at the health of these different companies and what's going on in the market, just keep that number in mind, that a 25% cancellation rate is kind of like expected at one of the companies that is doing their hardest not to cancel. Mm-hmm. All righty. Okay, builder deposits. So Brian brought this up as something that you guys would be really interested to know more about, what is going on now with builder deposits, because we just came out of a market where it was all over the place. It was whatever you were offering, really. So there's going to be different types, and I'm going to let Arielle speak to this a little bit more, and then I can go over the True Homes deposit at the end.
Sounds good. So for builders, they're going to go one of two ways. It's either going to be a flat fee or a percentage of the total purchase price. Again, this is going to vary based on the builder and really based on, is it an inventory home where the builder picked out everything, or is it a client build where the client selected everything? Typically, a builder is going to take a higher deposit on a client build because there's more risk there. Your client was allowed to pick out whatever they wanted, and if they wanted purple carpet and the builder put in purple carpet and they cancel, then the builder has to figure out a way to still sell that home with your client's selections. But on average, your flat fees are most likely going to range between $5,000 up to 10%. With a custom builder, they will do something, typically a little higher. It'll be like a cost plus model. But with custom builders, you're going to have to talk to them. They're a little bit of an anomaly.
Yeah, I mean, this is really good information to know, because keep in mind that there are some builders with all these cancellation rates who did that exact thing. They may have customized some things. Now they're having a bunch of cancellations, and they're probably not selling those homes for anywhere near what they originally sold them for in the height of the market. So this might change. You might see some builders go a lot lower on the front end and a lot higher on the design studio side if they're customizing. What True Homes whole strategy has been is, we knew this market was going to shift at some point. There was no way possible that we were going to stay in where we were. And so we went ahead and implemented what are our strategies going to be to make it more affordable and easier for people to buy so that we can keep our volume up. And one of the things we did is we came to a really good place with our deposits. We kind of played around with it a little bit and found out what seems to work the best, that's healthiest financially for everybody, but also affordable. And so that means you're going to have a total deposit of 2 or 3% on a build. So again, to Arielle's point, if you are customizing and building, you are going to have a slightly higher deposit. It is 2% if you use one of our preferred lenders like Melissa and Alex at Movement Mortgage, 3% if you use anybody else or pay cash. Very typically, other builders would be like 5%, 10% for cash. It's just not going to have the same level of accountability and commitment sometimes with cash. You would think the opposite, but that's another good thing to know. Sometimes builders have higher deposits for cash. Then that $1,500 you see on the screen, that's what's due at contract. They don't have to pay the full 2 or 3% at contract. They pay that at design studio. If it is an inventory home, it is only the $1,500. And that's where we have been very, very successful. That is very affordable for people on a quick close home. All righty. So you want to take this one, Arielle?
Sure.
Okay.
So we also have some great data about job growth, specifically in the Raleigh-Durham area. So you can see this chart's got a lot of colored lines. At the bottom, each of those colors represents a different year and the growth in jobs in the thousands that we've seen in the triangle. The line at the very top is what I'm going to focus on. That's the gray line. That's 2022. So even after COVID, which is the dark blue line that does that kind of check mark look, we are above and beyond the amount of jobs that we've ever had in the triangle. And especially we've rebounded very, very well since COVID. So that leads us to our next slide, which talks about what that growth looks like as far as employment goes. So we have all these different industries that people are working in. And at the far right, you can see what the change was. So what's growing and what's, depreciating as far as jobs in each industry. But at the very far right, it talks about the industry employment as a total percentage of jobs. So you can see our highest percentages of jobs are in trade, transportation and utilities, professional and business services, education and health services, and then in government. Those are very strong industries and great jobs for people to have here in order to afford buying a home. Now you can see leisure and hospitality definitely made a huge increase in the past year or so, which shows that there's a lot of people moving here and living here and wanting to do fun things and also coming for vacations here, but you don't want your economy based around leisure and hospitality. Unfortunately, they're jobs that tend to be a little more entry level and make it really difficult for people to afford homes in the area that they live. Like think about like a Wilmington or an Asheville, where a lot of the jobs revolve around the tourism trade. It makes it really, typically in those economies, the housing is really expensive, but the overall median income is pretty low. So we have a really good balance here, and we are focusing, Raleigh-Durham as a whole is focusing more on those professional and trade jobs that are able to give people the income that they need in order to afford the homes here.
Another really good point about that, guys, is the rapid change. So when you are talking to your clients who are not in that bucket, they need the entry-level homes, and they're like, oh, I'll just wait and see what other options come up. This is a really interesting thing to talk about, is that you've got so many people that are starting to make up more and more of the market that can afford these home prices. So just know that, and just be ready to talk about that with your clients. And it is backed up by data. Permits. So Brian's going to talk a little bit more about the building levels. So this is another on one hand and on the other hand kind of statement. So we're going to talk about the one hand. Brian's going to talk about the other hand. So what's going on over here is the number of permits that are being pulled on a 3-month average in Raleigh, in Wake County, Johnson, and Durham County. So when we say Raleigh, we mean our Raleigh market, but the triangle area, and we pay attention to the counties where we build. So what's interesting here is it's cyclical. It's always been cyclical, even back 2019, 2020. There was less of that cyclical cycle in the middle of those 2 years that we just had an absolutely insane busy market. Then you're going to see that it really peaked in the beginning of 2022 and then dropped way off. Some of the behavior behind this. It peaked in 2022 because of all of the market data prior to that and all of the demand. And then when the interest rates went up and affordability went down, we as a whole with builders, this is not just True Homes, but in the market, stopped pulling as many permits to do quick move-in homes. So we didn't want to be sitting on the market like we were at the end of last year as an industry with a bunch of quick move-in homes at the same time. So I think you're going to see we're still going to be touching the same number of homes, but the cyclicalness of it might come back, and you might see a lot more client builds coming to the market as options instead of inventory homes. As Arielle mentioned, it's less of a financial risk to the builder. You got this broken up by county. I really want you to pay attention to Durham. If you're selling in Durham, please pay attention to this drastic change. It is a little bit more impactful there. All right, so for month supply, we're just gonna very high level touch this, and then Brian is gonna go over this in more detail. But of the following counties, how many of them do you believe to be at a severely constrained supply level for the months of supply of inventory? So go ahead and put in the chat box of these 4 counties, Wake, Durham, Johnson, and Harnett, how many of them do you think are severely constrained? Bonus points if you want to say which
all of them. County. Wake, 4 of them, Wake.
Yep.
3 of them, Wake, Durham.
You guys are feeling it in Wake County, I see. All right, so here we go, guys. Equilibrium is 6 months. That's your orange line. Severely constrained is 3 months supply. Now, this is going to be data specific to where we are selling and our price points. So I do want to recognize that it may not 100% correlate to the MLS as a whole. But when you're talking about a builder like True Homes, who's intentionally trying to get into affordable spaces, this is really important information. So all of them are severely constrained. They're all hanging out between that 2 to 3 months or less price point. And I want you to look at the green line again. I'm harping on Durham because this is an experience that we have had as a builder where we cannot get affordable land there anymore. So if you have clients in Durham, I want you to be aware of that. And we'll talk about that a little bit more. Okay. All right, so the current month supply is back to the level we were operating in in 2020. So this is really important when you talk about all those headlines. List of sale price. Again, we're going to let Brian take this one as a whole. But again, this is going to be our markets where we sell our price bands. So when we say price bands, those are the different price ranges that we sell in. 100% list of sale price was pretty much the normal in 2018 for a bit. It's cyclical as well with the different seasonal markets. Once you hit the end of 2020 though, it skyrocketed, and pretty much most of the time everywhere, everything was significantly above list price. I think we're all aware of that. It has come down. So when Brian goes over this data about it coming down, what I just want you to be aware of is that 95% mark. This is still going to be relative. We're not 20% below as an average across the entire market. We're not 50% below. For what we sell in as True Homes affordable price ranges, it's still over 95%. This is going to be heavily impacted by new construction that is also often listed at one price and sold at exactly that price. It's going to be impacted by any distressed properties that are out there. Anything that just hit the market over the last 3 months, I would really say was playing the market and kind of trying to figure out where we were going as we're settling out. So we may see those data start to tick up again as we move through and we're a little bit more settled out. All right, Arielle, you want to do this one?
Sure.
This one's one of my favorites.
Yeah. Well, actually, you know what? You love this one. Go ahead.
Okay. I'm sorry. I'm talking a lot. So this one is price buckets for new construction. So each line represents a different price range. You've got everything from under 200 to over 750K plus. And so this is where everything has shifted. Take a look at that top line, 200 to 300K. Until 2020, it was the top line. It was the most of our new construction nationally, and it tanked. It went way down as the market went up. Now, the number of new homes selling under 300K nationally is 10%. Compared to where it was at 25 to 30% previously. The share of new homes selling over 400K, 75%. So essentially, you've got 15% in a nice sweet spot between 300 and 400, very limited supply, under 300, and almost nothing in the under 200 bucket. It just went to basically zero. And so this is talking about that affordability piece that Melissa will be able to jump in and Alex will be able to jump in and talk about, but this is hugely impactful to our market. This is why people are moving here. All right.
So land availability versus affordability. So land is something that builders keep very close eye on. This is what our business basically revolves around, is finding land and making sure that it's affordable for us to build on. So what is the equilibrium on the market for vacant lot supply? Does anyone know the answer? Throw it in the chat. And how do you think builders can create more affordable housing? If you have any suggestions, throw those in the chat as well.
We would love to hear creative ones.
Anyone know equilibrium on the market for vacant land supply?
This is done in month supply as well, guys.
No one's brave enough.
No?
It's okay. We'll give them the answer.
Okay. All right. Any solutions on affordable housing? You are being creative, not Brian. No, nobody's gonna jump in.
Lower the price and change the government, says Jay.
All right.
Okay. So month supply for vacant developed land. So
Equilibrium.
So yes, so equilibrium is going to be 24 to 36 months. It really is 24 months, but because of the long times to develop land, it's become 24 to 36 months for lot supply. And our month supply for land has been going down drastically. This has a lot to do with, Durham is a great example. I know we keep talking about Durham, but there is so little land left in Durham. Even like Fuquay is a good example too, that the cost of the land itself has gone up so dramatically that it's difficult for builders to be able to put the supply back on the market. You know, if the land costs a lot and we can only fit a couple of homes on it, it becomes this this give and take of, if we buy this land, will we be able to provide the homes at the price point that they need to sell for? And that's always the big question with builders.
So a good point here. I know we keep harping on Durham, but it's a severely constrained market. Last year, while I was in the Durham neighborhood that we have up in Huntington Valley that's finishing out, I had the VP of sales of another big, moderately sized builder in North Carolina call me and ask me a bunch of questions about the behavior that we were seeing, the data that we were seeing, and specifically told me that they were going to be about $200,000 higher than us as a starting price point in the same area. And they weren't even sure if it was worth continuing to develop at that point because it was getting so expensive with the land cost and the development cost. So just keep an eye on that kind of behavior. And that stuff tends to play out, to Arielle's point. You guys may not feel it or see it until 2 to 3 years after the builders are aware that this is going on. Solutions. So on the other hand, go ahead, Arielle.
So how builders can bring more affordability for new construction to your clients. There's a couple of ways that we can do this. One is going to be building on smaller lots. Pretty soon gone are the days of homes that are going to sit in neighborhoods anyways, that are going to sit on half-acre, acre plus size lots. The land is going to be the most costly aspect of any new construction home. And so in order to bring down the cost, we have to make the lots smaller. The other option we have is to build smaller homes. So back when the interest rates were 3% and everyone could afford so much more home, we were seeing people say, you know, 2,800 square feet at a minimum, 3,000 square feet at a minimum. Now, with the interest rates being what they are and the affordability being what it is, people are opting for smaller homes. They're more comfortable in that 2,000 to 2,400 square foot range. And so being able to provide that helps also lower the cost. And then, of course, operational excellence. This really comes down to the builder itself. What are they doing, and what strategies do they have in place to buy land at a more affordable cost, get your trades under contract at a more affordable price, And then typically, you know, having larger communities is going to allow a lesser cost per home for trades and land. The other thing you can do is you can move out from city centers. So if you look at the kind of little chart we have there, if Raleigh is $407,000 for your median home cost, moving
and I'm going to jump in and say that this data is from October 22. So Brian, don't get on us about this one.
But you can see just, you know, it's more of like a high level look. As you move out to these other, you know, more developing areas like Butner, Creedmoor, Sanford, Anger, Clayton, Zebulon, Rocky Mount, you'll see a lot of the builders, especially your more entry-level price points, are going to these areas. And that's because of this specifically. We can give clients a bigger home or a bigger lot or a better price by moving out of your city centers. It also has to do with moving from county lines. So moving from Wake County to Johnston County will save your clients money. And then also being outside of city limits, you'll have less amount in taxes for a monthly payment for your clients.
And how many of you guys were aware of Rocky Mount now being considered part of the Greater Triangle area? Doesn't that, like, for those of you who've been in business for a while or grew up around here, that's an interesting fact. But realistically, it's like Rocky Mount Wilson is like 45 minutes from North Raleigh. If somebody's already used to driving 45 minutes to an hour to go to work, or they don't have to go to work every day, this could be a really good solution for them. And that area is growing. Other point I want to point out here, if a builder has taken the time to make this graphic with this information on it, wink, wink, nudge, nudge, something's coming. Follow the builders. That's what I used to always tell my clients in general brokerage. Follow the builders if you want to build the best equity. Obviously, look at other factors as well. But if we are taking the time to run this data, make these charts, go out there, look for land potentially, then this is something you should just be aware of these different areas. Alrighty, so that is going to be it for our new construction perspectives. And then we're going to move on and our wonderful mortgage and financing update. Interesting fact about Melissa and Alex is they are currently #1, right?
We're number well, Lord willing and the creek don't rise, we should end #1 in our region.
In the region, in the whole region. And so how many states does that cover, Melissa?
Alex, do you know the answer to that? I've lost count. I quit paying attention.
It's a lot.
I mean, David's on the call, but I think it's about 180 something loan officers in his region. The last time I looked at that report.
This is impactful, guys. So while they're going over their information, this is their credentials. This is why they know what they're talking about. So just keep that in mind. They are top performers. And if they are not currently sitting in #1, they are close enough and they have counted down to every dollar what is coming and done the math. Trust me. All right. So what I'm going to do is I'm actually going to change this so that I can let Melissa.
You need to stop your share first.
Okay,
if you didn't know, David, we watched the
Brian
reports a little bit.
Brian keeps us on track. All right, so Melissa, make her a host. You got it? Okay, cool.
Okay, did I share the right screen? You're not looking at anything inappropriate? You're looking at a roller coaster? Somebody acknowledge that? Cool.
You're good.
So, I'm gonna speak up. I'm Melissa. I've been met for 4 years.
You're kind of going in and out a little bit.
Hold on a second. Melissa, you're breaking up a little bit on your microphone. Your video's fine, but your mic is not working properly.
Hold one. That should be better. It might have been too far. Is that better?
Yeah. We do numbers, not technology, as you see my computer's dying.
Yes. Okay, that should be better. A little bit of background. I've been in business forever. Fun story. I actually started as a realtor and Kate was my instructor. So anything wrong, all back to what Brian
Melissa is breaking up again. I think you might just be too far away from it, or you might want to move to like your computer's microphone.
Or it's my internet, obviously. Okay.
Tell your kids to turn off Netflix in the background.
Nobody's home. It's just me and the animal.
You got to get in the mic like a Baptist preacher.
Okay. Is this better? I'm gonna lean forward. Is this better?
Maybe don't move around so much. Try to stay in one place.
Switch it to your computer, Mike. That'll usually do the trick.
In a momento, sorry.
JC and Brian are always good for the comedic relief.
Alex, introduce yourself while I fix this.
Hi, I'm Alex. Melissa and I, we'll have this as our coming out party. We have teamed up this year, and we are doing everything 50-50. We started out doing that with True Homes and now are expanding that to outside of our builder relationships. I've been at Movement 4 years. Melissa came on about 3 weeks after I did. So we have been taking things together. Use fiber instead of cable. She's got Google Fiber. She does have fiber. Somebody's giving you shit for your internet. But we have thoroughly enjoyed taking on the Movement way. It is a very different experience from where we have been in the past. I was not prepared for this, so that's all I got.
All right.
Can you hear me?
We can hear you fine. It's me. Maybe this will work better. I'll just lean forward and look
So
silly.
much better.
Okay, I'm just gonna lean forward and look silly. As I was saying, sold real estate, bumped my head, met a guy, I don't know, switched over to mortgages and have been doing this ever since. For those of you on the call who have worked with me, you absolutely know, or you've experienced that this is where I belong. I did not belong selling real estate. Thank you for Brian for teaching me real estate, but that is not where my heart, nope, I belong here. With that being said, Alex and I work together and she keeps me level and calm. So if I get nervous or say something out of line, she's gonna correct me today. Yay, fun with mortgages. I'm just gonna
sit back and watch.
Thank you. This last year, I think everyone experienced the mortgage roller coaster. Oh God, please tell me this is gonna work. There we go. Over the last year, we all experienced it, that rates doubled. I'm sure everybody felt it, everybody panicked. Some of you probably had borrowers who did not lock their loans and stressed out. Fun fact, Movement does lock for up to a year. Put that in your pocket. But if you have anyone building, we can do extended rate locks for 12 months. When rates doubled over this last year, our purchasing power went down significantly. Anybody who wants this particular slide or any of the slides I have, just email me. I'm happy to give you a copy of this. It was not professionally done last night. But as you can see, as rates have gone up, what people could afford, they can't afford now, and where they're comfortable, everybody is having to reassess. Making sure you have a team who can sit down with your borrowers and maybe have conversations like, put less money down, pay off credit card debt, get into the house and get more comfortable, and having those difficult, hard conversations are what matters right now, is what matters right now. So if your partners that you are working with aren't educating your borrowers to look at all aspects, this affordability can change with the decisions that are made initially. I didn't mean to talk about that, but we talked about that. As rates have gone up, part of what lenders are experiencing is historically rates are in sync with the 10-year Treasury. Alex will agree with me that this last year that wasn't always the case. In the spread between the Treasury and where we should be and where we actually are is quite significant. Does anybody know or understand? And I don't have the chat box open, so Alex or Ariel help me with this, but do any of you guys understand what the 10-year Treasury is and what it represents for us?
Crickets, so I'm gonna go with no.
I think you're gonna have to explain that one.
You got one.
Who said it?
Bobby says yes, if you want to let him explain it.
Oh, yeah. So, of course, Bobby knows the answer, and so does Brian. But for the rest of us, and I tried to find online layman's terms because I went down this whole rabbit hole with this last night. So basically, the 10-year Treasury is issued by the government. And when we invest in the 10-year Treasury, it's us all of us, businesses and individuals, saying, hey, we believe everything is healthy right now. Financially, we're healthy. Financially, we're in a good spot. Obviously, that's not what happened over the last year. Obviously, there was lots of changes with that. So you can tell that everyone's panicking. Inflation has changed. Numbers are coming out that some people will say we are actively in a recession. Some people will say we haven't checked all the boxes. Melissa says we're actively in a recession, but maybe my financial planner sister would yell at me for that. But as you're looking at this and you're paying attention to it, the 10-year treasury wasn't something we could use this last year to tell you what was happening with rates. We were all paying attention to inflation. And as they've moved rates, and Brian, I did not put slides in this because I figured you were going to touch on that a little bit more than me. And if I'm off base, anybody who wants to call me, we can talk about it. But as inflation changed, and they are doing everything they can to keep inflation down, so are rates. So are rates changing. Coming into this year, it's very interesting what everybody's outlook is on what's going to happen with interest rates. Alex and I both spend a significant amount of money monthly to have professionals give us their advice, along with we follow Fannie Freddie and look at what NAR and the Mortgage Bankers Association is going to say. With that being said, I'm sure you guys have heard every lender out there, and every lender on this call has said it. We expect rates are coming down, and towards the latter part of the year, we're going to be refinancing everybody that we put in loans last year, particularly people we put in loans in October. Those October loans are going to be the first ones we refinance. I'm sure a few of us, yeah, I'm sure
all the ones over 7%.
Yeah, I'm sure a few of us did 7%, and yeah, we were all over the board with that. So as you can see, everybody's saying it's going to be third and fourth quarter. I will tell you, this weekend, I quoted low fives for an FHA loan. Let that resonate for a second.
With some
Melissa,
points.
can you tell them about where we are right now, conventional versus government-backed programs on rates? Are you hitting that?
Hold on. So I don't have the slide that shows conventional versus, but this is, and I'll get there in a minute, Nicole. This is the roller coaster that has been rates over the last few years. Brian, I'm going to pick on you because you're the easiest. What was your interest rate on your first house?
17 3/4.
Mm-hmm. You guys, funny story. When I got into the mortgage business, I had a memory come back that I wasn't sure if it was true or not. So I called my parents. My parents celebrated that they got a 16% interest rate on a VA non-credit qualifying assumable loan. They assumed somebody else's mortgage with no credit checks or anything, and they celebrated 16%. Fast forward to 2021, when I got my mom and dad into a home here in North Carolina, a VA loan that they qualified for. Y'all, I got him in at 2 1/4. My dad flat out has said he will never leave that house. Unfortunately, that means my parents live close to me for the rest of my life. Anybody who knows my parents will understand that sigh.
There was a question. Oh, no, this wasn't a real question. Well, I guess maybe it was. Brian, when did you buy your first house? I'm going to say it nicer than it was said in the chat.
Late 80s.
Okay.
All right. So with that being said, as inflation eases, if inflation eases, according to my camera's right in front of his name. Yeah, Greg. According to Greg, who's the chief financial analyst for Bankrate, he's also saying, rates are going to pull back as inflation comes down, as our economy adjusts to the new world that we're in. We are going to see rates come down. As we see rates come down, it's going to have an influx of buyers in the market, right? But we still don't have inventory. So Nicole, tell True to build faster, please, so we can have some inventory. If someone could figure out how to,
and you couldn't hear my laugh. We're doing everything we can.
Right?
I think it's also important for you guys to convey to your clients when we talk about rates coming back down, when they come back down and we hit those mid to low fives, if we hit that, that's likely going to be the bottom. Like the people that are holding out, waiting for these 2s and 3s to come back, that's probably not ever going to happen again unless we are in a complete state of disarray like we were for the last 2 years. That was not a healthy market. And it's very, very unlikely that that's ever going to happen again. So we have to keep controlling that conversation with our clients. The longer they wait, the more it's going to cost them.
So it's our job right now, more so than ever, to control the narrative out there. People are scared, people are waiting, people are unsure, people don't know what to do. Right now, each and every one of us on this phone call need to control the narrative. We are ahead of the news. Everything we're hearing in the news is 2 weeks late. So when the news comes out and goes, oh my gosh, rates are rising. Yeah, every lender has been dealing with that for 2 weeks. When they come out and say, yay, rates are coming down. Yeah, that happened 2 weeks ago. So every one of us on this call right now, it's our job to control the narrative. It's our job to put the good news out there and say, oh my gosh, rates are in the mid 6s, high 5s. What an opportunity to buy right now. If we are going to our clients and our customers and we're going, oh, rates are in the 5s, they're going to panic. So this is our opportunity, you guys. This is our opportunity right now.
Before you move on, a question for Brian. He might cover this later, but I think this is good perspective on the rates. Brian, what are investors doing right now who are well-funded and healthy?
Investors that are well-funded are paying cash, but what they're doing is they're putting their cash into like a money market or something with an investment account. They're borrowing as much as they can because the interest rate is often going to be better in the long run than what the payoffs are. The interest rate on the account for the investment is going to be typically a higher return than what the interest rate is. So they'll actually end up at the end with more money still in that account, even after it's paid off. I learned that from my financial advisor, Jim Staples, that's actually listening in the background. So he taught us that a couple of years ago.
I learned that from Brian.
So my last slide and the last thing I want to talk about is for the last couple of years, agents and lenders have been able to dictate, we want the easier loans. We don't want to do an FHA loan. We don't want to do a VA loan. We don't want to do a housing loan. But ladies and gentlemen, right now, we want to do those loans. Right now, if we want to help everybody get into a house, we have to be open to some challenging opportunities. Right now, there are loans out there. Movement has over 3,000 loan products. There's a loan for them. They just need the time. Gone are the 2-hour pre-approvals. We are back to, we need time, but your team can do it given the right opportunities. I probably missed a whole window, but I got nervous and I'm sweating. So if anybody has any questions, this is the end of my stuff.
So I have 2, right? So what is the estimated? I know you have probably go pull stuff. It's not time yet, I don't think, for stuff to have rolled out yet. But going back to the slide about the government-backed programs, yep. What is generally kind of the spread, the difference on a prime credit score between FHA, VA, USDA right now and your conventional loans?
I can take that one so you can take a second and catch your breath.
Well, I actually know the answer because I just did this night. I have a borrower who I could look at a government-backed loan or a conventional loan. They were on the cusp for both options. If I took them with an FHA loan, his rate was 5.125, paying 1% for points. If I took him conventional, his rate was 5.875 with 1 point. I chose to go conventional. The borrower chose to go conventional because their mortgage insurance was significantly cheaper. And even though the rate was higher, my monthly payment was significantly lower. I was the 7th lender he talked to, and I was the first lender to explain the 2 different options.
I think that's hugely impactful, guys, and that's why I asked that leading question, because I have another one for Alex, but we're seeing people who are coming in and they thought they were only going to qualify one way. They have conversations with our preferred lenders. They can go another way. And as long as it makes sense for them, their buying power is significantly impacted. Generally, though, for most people right now, FHA, VA, USDA, those are all going to be at a lower rate than conventional, which used to kind of be the norm. There's a reason for that. But then when we got into the period that we did over the last 2 years, what Melissa was referring to is that we saw a whole lot of people start to, the lenders were starting to shift on where they were putting rates and stuff, and some of the backed ways this is all backed affected that. But they were kind of evening out. And so now your FHA, your VA, your USDA buyers are generally not going to be paying attention to the rates that you're seeing conventionally quoted on the headlines, right? They're probably in a different place. Alex, a question for you. What does that mean for a seller accepting that loan when potentially, let's say that it's, you know, USDA versus conventional and that rate spread? Some of the fear factors with sellers is, oh, they don't have the money to put the money down. They're not as secure. Same thing with VA or FHA. So tell us what that like security actually does when the rate is where it is.
My opinion is it doesn't have anything to do with the rate. So if you look at VA versus conventional, one of the common misconceptions, people go VA because they don't have any money. Their credit sucks. If we go back and look at the national average, your credit score is higher for a VA borrower than it is a conventional borrower. Just because they don't have to put anything down doesn't mean that they don't have it to put down. Most of our VA buyers do have it to put down. Now, there will be some one-offs, but for USDA, your USDA qualifications are more strict than your conventional. So they may not have the funds, but they have to be a more well-qualified borrower to get into a USDA loan. Debt ratios are 5 to 10% lower. Same with North Carolina housing. People are scared to take North Carolina housing loans. The debt ratio qualifications and the credit qualifications are higher to get into a down payment assistance loan than they are your standard FHA loans. So the rate doesn't really have any effect other than they have more buying power, especially with the new loan limits for FHA in all of our surrounding counties this year.
And something to keep in mind, everyone who went, appraisals, you guys, there's a lot of misconceptions with appraisals and who, what, where, when, why, how. So don't panic and say, I don't want to take an FHA loan or a VA loan because of the appraisal. Have the conversation with whoever the lender is, tell them about the property, and then see if the lender has any concerns. Before you take it away, my 30-second plug real quick, guys. Gone, I need you to hear this, agents, gone are the days of your 30-minute pre-approvals. Please get your borrowers in front of your lenders early. Anybody who was super well qualified probably did something. Everybody else who's coming out of the woodwork now, they need time, and your lender needs more than 30 minutes to review credit, income, and assets. So 24 hours would make a huge difference versus 30 minutes. And if you're calling and they're saying, I need more time, give them more time. They're looking for a solution. That's my plug. Okay, thank you.
Early and often.
Early
with
and
the rates
often.
With the rates changing, we still need, because these people that are coming out, they have very set budgets, and a quarter point change in rate may not mean anything to us, but that may be a huge difference in their budget and their qualification, and you guys don't want to be spinning your wheels.
You guys are amazing. We're gonna do a Q&A with you later. So they are not going anywhere, guys. But next up, I'm going to be letting Brian take the stage. So in just a second, he'll start sharing. So he's gonna go over real estate market trends. Brian is not shy about telling you guys about his experience, because I think it really actually helps to know where he's coming from. I stole this from his LinkedIn. So he has over 30 years of experience in real estate. He's supervised teams selling over $1 billion, and he has experience running a $30 million team. So when Brian is talking to you, he comes from a perspective of an educator, but also somebody who's in this business and has been doing it for a while, and also as an investor. So he's been on all sides of this, and that's why we really wanted to partner with Brian and give him the chance to share this information with you. So Brian, if you want to take it away.
Yep. If you will stop sharing your
Yep.
screen and make me host so I can share mine.
Yep.
And let's see if I can get this up here. Can you guys see the onward and upward slide?
We can see the PowerPoint.
Okay, hold on a minute. Bear with me here. I'm trying to get start from beginning. All right, can you see the
Yes.
alarm clock and onward and upward? I got everybody?
Yep.
All right, very cool, very cool. Okay, so first thing I'm gonna do, this is my contact information in the chat box. So if you have any questions after we talk today, feel free to give me a call or email me. Now, I'm gonna let you guys know, I'm gonna give you a ton of information today. For those of you that I have not met before, this is kind of my background and all of my contact information. So if you wanna follow me on Insta, TikTok, Twitter, and YouTube. If you're on Instagram following me, you're going to see a lot of pictures of my smoking hot wife, Kirk, and she's actually on here listening today, along with the financial advisor she works with, Jim Staples. So I mentioned them a little bit earlier, but this is how you can get in contact with me. I want you to do me a favor. I want you to go ahead and pull out your phone, because you're going to need your cell phone for what we're going to do today. We're going to give you have a little fun with this. For those of you that have not followed my stats before, I'm covering a 16 county area, including the entire Triangle MLS. This is what was originally the Triangle MLS back in about 1999. This is the 16 county area that it originally covered. If you recall, last spring, we added Fayetteville into it. We're going to be adding the Burlington Alamance MLS. And my belief personally, for those of you that are in Wilson, Rocky Mount, Nash County, probably going to be adding your MLS at some point in the next couple of years. So don't be surprised with that. So here's what I need you to do with your phone. Can you guys see the screen okay? Give me thumbs up. Give me thumbs up, little interaction here.
Brian, they wanted you to also know they can see the next slide. It's the notes portion that they can see.
Oh, well, that's not what I want you to be seeing. Crap. All right, hold on a minute. If you can see it, that's fine. So I'm looking at I want you to make sure, are you able to see? Let me get my little gray screen off of there. Now, can you see the entire slide?
What we see is the slide, then the next slide, then the notes on the right-hand side. That's what we're seeing.
Okay, but you can't see my video box that's got all of your smiling faces for those of you that are here. Okay, all right. So just stick with me. We're going to keep rolling. We're not going to take any more of your time. Pull out your cell phone. Send a text. The number that you're sending the text to is 22333. And in the body of the text, type no spaces, Brian Pate 428. Brian Pate 428. We're going to be using that all throughout our segment here. So let's go to our first slide. What was the lowest amount of active listings in the 16 county MLS area? What was the lowest number of listings? All right. You guys are doing real well. The lowest number of listings was actually 1,280 listings on March 15th of last year. That is the lowest I have seen in my 30 years in the business. For those of you that don't know, I was licensed BI before internet. Okay. So my state exam, I actually took in person at Wake Tech. For those of you that are in here, welcome to the dinosaur era. We're talking prehistoric days of real estate, if you follow along. Let's go to our next question. What was the median days on the market for all closed properties in MLS in 2022? This includes resale, new construction, modular, manufactured, townhome, and condo. What do you think the lowest number was? What was the median days on the market? Remember, hint, this includes new construction. Yeah, we got a lot of interaction going on, you guys. That's good. I'm glad to see. And by the way, if you're sitting in front of the computer, will you do me a favor and turn on your camera? Because it's really hard to talk to black screens on the grid. So if you, thanks, JC. What's up, man? How are you? Look at that. You're not wearing a bow tie, man. I've never seen you in a hoodie. Okay, you got it on the shirt. That's good. There's Bobby Carroll. There's Renee Hillman, looking great as always. Thank you so much. I appreciate that, guys. It makes it a lot easier. So the answer to this question is that the median number of days on the market was actually 3 for closed properties, 3 days. Remember that includes new construction, which is listed at 0 days on the market. So you have to keep that in mind. I want you to understand very clearly what we are using for our specific numbers. So that's why I want to go through these. Let's go to our next one. What was the median sold price in TMLS in 2022 for all properties? What was the median sold price? Let's see how you guys do on this one. Just send that text with your favorite letter there. Oh, we're getting a lot of opinions on this one. Lots of opinions. So for the first time in history, the Triangle MLS broke through the $400,000 mark on the median sold price. The correct answer here is D, $402,970. That was the closed value in that one. So that's where we're seeing it. So this slide, by the way, the slides that I have shown you with the graphs, I'm going to make those available to you. I am going to give them to you via a link in the chat box before we leave today. So don't leave until you've gotten those. These are tweetables, folks. For those of you that don't know, I call them tweetables. It's stuff that you can share on social media. You can take these slides, by the way, and you can R&D them. JC, do you remember what R&D stands for? It does not stand for research and development. It stands for rip off and duplicate. So you can take these, you can put your own logo over the Brian Pate Seminars logo, and you can put them on your own Facebook, InstaChat, Snapagram, whatever you're using for your communication. So have at it. You get to steal these and you get to keep them. See, JC's laughing at me because I accidentally said InstaChat and Snapagram, and he knows that I know better. I'm not quite that old yet. Okay. I do have a very important graph to show you. This is the number of homes sold in the Triangle MLS since 1998. Now, I know that makes me sound really old that I've been keeping an Excel spreadsheet. This spreadsheet, to give you an idea, started on Lotus 123, for those of you that are that old. So Bobby Carroll, I'm talking to you. Lotus 123 sheets. I see Renee laughing too. She gets it. But this is a graph of how many homes have sold in the Triangle MLS over the last 25 years. And as you can see, we are still in the peak mode where we've been. 2017 was actually the beginning of the high growth levels, but let's go back and look a little bit. In 1998, we sold 16,213 homes. The next low back down in that range was in 2011. If you were a realtor between 2007 and 2009, God love you, you're still here. The heart's still pumping. We're still good. It was really difficult time. We saw inventory jump to its highest levels in those days. Active inventory in late 2010 and early 2020, or excuse me, 2011 was actually almost 20,000 active homes for sale. 19,906 was the highest point that I've ever recorded. In 2017, we broke through the 40,000 homes sold barrier for the first time. A lot of people have said, hey, the market's crazy right now. What, you know, we sold 48,000 homes in 2021. Oh my God, it's dropped this year. But guess what? We're at the same levels that we were in 2017 and 18. So if you hear realtors saying, oh, the market's terrible right now, pardon me, this is a Brianism. They're full of shit. The market is still good, folks. Okay, for those of you that I offended, I apologize. It's just Brian being Brian. I'm not in a CE class today, so I don't have to follow any rules. I'm here to make Arielle smile and see her laughing. So that's the whole point of this. But if somebody's telling you that the market's terrible, you need to get on your horse, start calling your sphere of influence again, and start connecting with people, because the market is still good. We're still going to sell about 39 to 40,000 homes this year in the Triangle MLS. So don't be sitting on your keister. Take your opportunities and make something of them. All right. let's have some fun and let's talk about the people that you're working with today. What was the average or what was the age of the typical first-time home buyer in 2022? Let's see what you guys think here. I'll give you a hint. In 2021, it was 33 years old. So let's see how you do here. Give you about
Brian,
5 more seconds. Yes, go ahead.
we can see the answers on the next slide.
Well, yeah, you know, some things happen, and yet some people are still getting it wrong. That's the scary thought. See, Roxanne's smarter than everybody. She's looking at the answers. Yeah, so unfortunately, we're still dealing with that. But
okay.
So here's your answers, folks. First-time home buyers made up 26% of the marketplace last year, down from 34%. Typical first-time home buyer was 36 years old. That's a jump of 3 years. We're starting to see families starting later. We're going to talk a little bit. Let's talk about the demographics here. 61% married. 17% of recent buyers were single females. So all the single ladies. You don't need to take pictures of the screen. I'm going to send you all these slides, everybody. So I see you, Melissa Schwartz, taking photos. You don't need it. I'm going to send you all of this information. You're going to get to download all of this data in a Word doc. So stop writing, stop taking notes, stop doing other stuff, and just listen and watch, because I'm going to give you everything here. So single ladies, you're 17% of the home buyers last year. 9% single males, because we're not as smart as you are. 10% were unmarried. All the people living in sin, starting to buy houses together, have babies before marriage. Fine. Do you, it doesn't matter. But this is the highest share of unmarried couples that we have ever recorded. Again, amongst those first-time buyers, 18% of them unmarried. So you need to be prepared to have those discussions. Remember, we can't give legal advice on whether to own as tenants by the entirety, joint tenants, or tenants in common. But you need to have the discussion so that we make sure if they're owning the property as tenants in common, they need to have a will. If they own as joint tenancy, they have the right to choose that survivorship. You can give them options on that and explain to them, and then make sure that they speak to an attorney. Remember, be very careful not to give away any attorney advice. Our license does not handle that. All right. What percentage of senior home buyers age 16 up purchased a condo? Let's see how you do on this. Aha. I'm going to get you on this one because the answer is not on the screen this time. He's getting sneaky. Okay, we got a couple people said 8%. All right, Neil Gallagher's in the waiting room. Neil Gallagher is now in the building. Yeah, so there's a lot of different questions on this, as far as, you know, we automatically think that people that are getting older are going to buy a condo. Well, it's pretty amazing, because most of them, most of our seniors, they're buying single family homes, folks. We're going to talk about that a little bit more. So 12% purchase new construction. 12% purchase new construction. 1 out of every 10 or better is purchasing new construction. If you're not, on your days that you don't have anybody to show houses to, you need to go out and be looking at property. You need to go out looking at every new home community that you can find. Seniors related to the housing market remain steady at 7% for buyers over 60. 17% purchased condominiums. 17 purchased condominiums. 8% purchased townhouses or row houses, but 75%, 3 out of every 4, are still buying single family homes. So True Homes, make sure you got those ranch plans. I know that lots are getting smaller, but if somebody were to build a ranch plan right now with 1,400 to 1,500 square feet with a 1-car garage and put it on the market at about $275,000 to $300,000 with a 1/10 of an acre lot, boom, done, gone, choo, 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 choo. It's like throwing all the deck of cards out. So be aware of that. Average distance moved, this increased too. It was only 15 miles for the past 3 or 4 years. The distance moved was now 50 miles. People are moving away from urban centers. People are moving out. Why? So they can get more land. So developers are doing a lot higher density development these days. So what was the most important factor in location? What was the most important factor? Let's see how you do on this. There's a hint on your screen if you're not looking. All right, you guys are slowing down on your responses here. You guys texting friends or what? What's going on here? If you're looking down, if you're trying to hide and you're looking down at your crotch, I'm hoping you're on your phone. That's all I'm saying. We'll just leave it at that. Okay. So 49% of home buyers said quality of the neighborhood is the most important factor. Here's the challenge as a realtor. Your definition of quality and their definition of quality may be different. So you got to get back to asking questions. You got to get back to asking the questions. Of course, being around people that you know, like, and trust has always been a big deal. It's still up there. Here's some interesting information. This is something you can give to your buyers. In 2022, buyers were purchasing the home at 100% asking price, and more than a quarter paid more than asking price in 2022. Largest numbers ever in this case. This is the best tweetable. This is the best tweetable that I think I have on here. So if you're not catching this one, pick it up. The typical home purchased was 1,800 square feet, 3 bedrooms, 2 bath, built in 1986. So if I were a True Homes new construction person, I'd be taking this to my higher up saying, hey, here's some statistical data. We may want to be 100 to 200 square feet below and maybe 200 to 300 square feet above this, and we can sell more homes. You can take this information and use it, folks. This is where you have to talk about realism to your prospective buyers. So make sure you're having that discussion. All right. I love this one. I love this one. What percentage of recent buyers found their agent to be very useful or somewhat useful as an information source? Do all 4 of those numbers look low to you, by the way? Oh, there's someone with a total lack of confidence in the realtor community at 57%. We got a little bit of everybody answering on this one. Yeah, notice the answer is not on the coming screen, so you can't see that. See, I was worried that might happen, so I blocked some of these. All right, I give you the answers here in a couple seconds in 5, 4, 3, 2. All right, so it looks like you guys have said 72 or 57%. So let's give you some stats first of all. 47% of buyers started their process online looking at properties for sale. 86% of the time they went to Zillow or Realtor.com. You know, I know Zillow, the Zestimate. Look, I asked Santa Claus this year for a new airplane and a pilot's license. And he said, I'd rather give you a Zillow estimate. It's not near as, it's harder to get you that sale price number. You see where I'm coming from here. Okay, so 18% of buyers started by contacting a real estate agent. Well, where did those real estate agents come from? They found, so they found them through referrals, you guys. They found them through referrals. They found them through referrals. And if you didn't hear me, they found them through referrals. If you're not communicating with your database consistently, regularly, honestly, and often, you're missing your opportunities. 86% of people are telling us we're useful. That's good. Considering they don't trust us, they still consider our information useful. Remember, if you've taken the ethics class that I teach for your ethics certification, we talk about the fact that we're ranked down there with attorneys and congressmen as how much people trust us. That's because of the low-hanging fruit that's out there. Be better. Be better. I loved this one. Buyers typically search for 10 weeks and looked at a median of 5 homes. How many of you wrote offers on at least 5 homes within about 4 or 5 weeks of working with somebody and probably lost it out to a bidding war? I had one scenario that a buddy of mine had a listing in Trayburn, listed for $1.2 million. His client made an offer of 1.7 with 200,000 in due diligence, 200,000 in earnest money, and his buyer lost the bidding war with almost 200,000 non-refundable up. 60% of your searches were done on a mobile device. If your website is not mobile friendly or you don't have a solid app, you're missing opportunity. Only 34% of us old people actually still use the desktop or the laptop. guilty as charged. Sorry, but I can't read it on that little bitty screen. So I'm dealing with that. And this is the other one that I love. 91% of people satisfied with their home buying purchase. Unfortunately, they're only somewhat satisfied, not completely. So again, 86% of buyers purchase their home through a real estate agent or broker, and 10% bought for sale by owners. I don't know what happened to the other 4%. I didn't get that information. Okay. But here's what you need to know. Here's your job. Here is your job description. If I'm telling people this is what I'm going to do for you, I'm going to say, I'm going to help you find properties that fit in your price range that you can qualify for, that are in the best resale areas. If you've never taken my session on the 3 questions to ask people, would it be helpful to you if I could provide you a list of all the homes in your price range along with details and photos of the property? Would it be helpful if I could show you which of those were overpriced? And would it be helpful if I could show you which of the remaining homes were in the best resale areas? Those are the 3 questions. If you haven't taken that class, you need to sign up for those classes down the road. That's one of my training sessions through Brian Pate seminars. 38% used an agent referred by a friend, neighbor, or relative. 10% found an agent while inquiring about a specific property. Your signs are not creating the opportunities for closings as much as they used to. You need to be dependent on receiving referrals from friends and family. If you are not working your database, you are missing the opportunity. What percentage of buyers would be willing to use their agent again? What percentage of buyers would be willing to use their agent again? Pull out that phone and give me an answer. What percentage? I'm going to give you about 7 or 8 more seconds. 8, 7, 6, 5, 4, 3, 2, 1. All right, gang. 89% of buyers would use their agent again. 67% of buyers only interviewed one agent. That means you got to be first. That's why your referrals are so important. Anybody else go to a restaurant and you hear the table next to you talking about buying a house and you go, you look like a meerkat looking over to the table next to you? Yeah, we all do it. It's okay. That's your job. It's what we live for. All right, let's try this one. What percentage of home, but we told you 89% would use the same agent again. How many actually did? Put your answer on here. Go to your phones. Going to count it down. Here we go. 7, 6, 5, 4, 3, 2, 1. Ladies and gentlemen, how in the world did 89% of home buyers say they would use the same agent again and only 12% of them actually did? You know who that's on? Everybody take your thumbs and put them out like this. Take your put them now, point them back this way. That's on you, gang. That's on you. That means you're not communicating with your clients. So in the words of Bob Newhart, for those of you that are old enough to remember it, Bobby Carroll, I'm talking to you. Stop it. Stop it. Okay. All right. The typical home seller last year was 60 years old. Our sellers are getting older by average. Most of the time they're moving closer to grandkids, or they're moving to the final property, or their neighborhoods become less desirable. Pretty consistent like it has been. Again, the final sales price was at 100% of the final listing price. That's the highest number since 2002. We showed you those numbers a little earlier. And 91% of the sellers were at least somewhat satisfied with the selling process. So why didn't they send you another referral while they were selling? Because you forgot to ask. The best people to ask for referral is not past clients. It's the people that are going through the experience with you right now. So stop waiting. Stop being scared. I had one client years ago. I used to hand him a business card every time I saw him face to face. And he finally looked at me. He called me one day. He says, I finally got a referral from you, so you can quit handing me those cards. Keep doing it, guys. Keep doing it. So let's look into Brian's crystal ball, and let me show you some things. I want to go through a couple of things. This is 10,000-foot thinking here, so keep an eye out here as we're going through this. Number one, Ukraine. if war breaks out in Ukraine and the United States gets involved, all bets are off on everything. Now, typically and historically, we have seen the economic impact, the short-term economic impact has been really good, but down the road we pay for it with a recession. So if we do get involved in the war in Ukraine, which is still possible, you guys, I don't want to see it. I'm not a warmonger or anything, but it seems like we're getting pulled and pulled and pulled. And it's not that I don't trust our folks, it's this, I don't trust Vladimir Putin. That's all it is. But if we start going through war in Ukraine, total unpredictability is what we're going to face. So we talked a little bit earlier, Melissa was talking about inflation. So just so you guys are clear, mortgage rates do not follow the Fed rate. Mortgage rates, say it to yourself, mortgage rates don't follow the Fed rate. They follow inflation rates. If you look and you track mortgage rates and inflation rates on the same chart, they're going at the same rate. So keep an eye on that as it's going through. As lower monthly numbers in the first and second quarter of this year replace the higher numbers from last year, the inflation rates are going to go down. The government is still saying their target is 2%. I'm not sure that we're ever going to see 2% inflation again. I'd be thrilled to see it, but I don't think we're going to see that. I'm expecting mortgage rates. You know, Melissa talked a little about her thoughts, and Alex mentioned hers. I agree with them that I think that the days of 3 and 2% are gone permanently. I don't know that we'll ever see that again. I do think that we might see some low fives by the end of summer, and we may even see some companies with high fours. When that happens, all of these people that have bought in 2022 are going to be in refinance mode. So make you an Excel spreadsheet with your client and that bought from you in 2022 and look at what their interest rates are. You could score massive brownie points by sending them to Melissa or Alex and getting a refinance in place probably by the middle of summer at this point. And their reaction is going to be, well, we just did the financing. Yes, but you can now drop your rate from 6.75 or to 7.25 all the way down into the mid fives. That's a massive savings, as you saw with that slide that Melissa showed us earlier. Again, I just don't expect rates to be below 4% ever again. If they may, but I just don't see the logistics of that happening. So for those of you that don't know, this guy with the glasses on, this is Jerome Powell. He's a dirty, rotten so-and-so. Every time he opens his mouth, the stock market jumps and drops and becomes as volatile as it ever did. He said over a year ago in March, before interest rates started jumping, he said, we have to take advantage and make people stop buying houses and cars. Well, guess what? Have you looked at the car lots lately? You're starting to see more cars on the new car lot. We're also beginning to see inventory hiking in the real estate business. The one difference, they're going to continue to hike rates here over the next couple of months, but I think they're going to be 25 to 50 basis points instead of the 75 basis points that we have been seeing. For those of you that don't know, a basis point is 1/100th of a percent. So if interest rates go from 6 to 6 1/4, that is a 25 basis point jump. Okay, just in case you didn't know that. The big problem with this is the Fed left rates way too low for way too long. Rates should have been going up in 2018, 19, and 20. We should have already been in the 3 range, so that at the Fed rate, so that mortgage rates were in the 4.5 to 5 range. They didn't do that, and now we're suffering the consequences. That's a combination of administration influence, it's a combination of financial influence, and it's a combination of nobody wants to be responsible for interest rates going up because it pisses people off, bottom line. New construction. For those of you that don't know, inventory is not just about, JC, say hello to that young man for me. That's adorable. The inventory is a situation, folks, where it's not just about what's for sale, what's on the market, what's our supply versus demand. Inventory, every year there are about 100,000 homes that come out of ownership. They burn, they are torn down to build something new. There's a whole bunch of different reasons for this to happen. It can be fire, tear down, weather damage, whatever. But it's the job of new construction and developers to build those new properties. Okay. Now, in relation to that, approximately 100,000 homes were moved a year. There were 4.6 million homes built nationally in 2022. We really need to average 6.5 to 7 million for 4 to 6 years in order to catch up with the inventory that we've lost. Remember, I showed you from 2010 to 2017, we weren't selling, but maybe, 25 to 30,000 homes a year, but new construction was a very low percentage of that. And I'm going to show you a spreadsheet for that here in just a few minutes. But it also has to do with the migration patterns. So all of this comes together, folks. For those of you that have taken a class with me before, you know that my grandfather, Martinez Baker, I called him Papa. Papa used to have a saying. He said, it's not the opportunity of a lifetime if you don't have the cash to take advantage of it. So if you are thinking of investing yourself, this is the year to do it. This is the year to do it because home prices are going to continue to increase. We've shown you that already, and I'm going to show you a couple of other Excel spreadsheets when we finish with the presentation here. But the opportunities are going to be there. So with that said, let me try to help you get some business this year. It's time for tweetables. All right. So these are my favorite pieces. These are the things that we're going to give you to use. And I'm almost finished here. I know some of you may have an appointment to go to, so I apologize, but I'm still going here. So stick with me. First of all, true or false? The average in 2023, the average person will have more conversation with bots than with their spouse or significant other. True or false? How many of you realize how many bots you're talking to every day? Yeah, we are going to have more conversation with bots this year than I will with my wife. That's the sad part. Okay. And she, just for the record, she's much hotter than the bots are. I want to make that clear. What percentage of the world's population is under 30 years old? Folks, the youngsters are taking over the Gen Z or generation. They're not Generation Y, they're Generation Why Not. Tell them they can't do something. Their first question is, why not? Anybody else got an 18 to 23-year-old right now? Yeah, I'm just calling my children Google because they know it all, or at least they think they do. So just look at your kid, go, thank you, Google, every time they argue with you. So this, again, these slides, I'm going to give you copies of these, you guys. I'm going to have them available for you. This one will be available via an email in just a little bit. But in 2023, 50% of the world's population is under 30. Look at the African continent. Look at the African continent, the number of people that are young there. There are families in the United States are getting smaller. We're seeing an average of about 1.7 kids per family, where 20 years ago was 2.4. Our children, if you're a Gen Xer like me, or if you're one of the older millennials, by the way, millennials begin to turn 43 years old this year. So more than half of the millennials are eligible to be president of the United States, and more than 3/4 of them will be eligible to be president before the next election. Just let that sink in, and let's think about that one for a moment. The average attention of a goldfish is 8 seconds. What is the average attention span of an adult human? See how you do on this one. Yeah, you guys are cheating. You're reading the next slide. It's 7 seconds. 7 seconds, okay? So I'm not going to do any more with the phone, but I am going to give you some slides. You can take a picture of these slides if you want, because you may want to jump on this and get it out there quicker than I can get it to you, okay? So here's my first one. Today's college freshmen have no recollection of the recession of 2006 through 2009, and they have never licked a postage stamp. Think about that one for a minute, okay? I see you, Calvin, laughing at that one. Yeah, it's one of those. All right, the next one may be the scariest statistic I have for you today. That is that 1 in 3 people surveyed would rather give up sex than their cell phone. You people need to go to hell. You should rot in hell for answering that. Just telling you, not everybody's as lucky as me, but that's a different discussion. Over 90% of buying decisions are influenced by social media. If you do not have your social media game on point and you're not targeting the right audience, if you are trying to target 25 to 35-year-olds through Facebook, you are wasting money. You are wasting money. By the way, this is Brian's statement of the day, okay? Please, 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 nobody cares how long you've been in the real estate business. Nobody cares how much volume you sold last year, and nobody cares if you just won an award for the month. What the client that you're trying to market to cares about is, what are you going to do for me? What are you going to do for me? So stop it. Stop being just like everybody else. When everybody's doing it, you're not standing out. And finally, ladies and gentlemen, my last gross stat of the day: more people in the world own a mobile device than own a toothbrush. Yuck. That is nasty, just for the record. Makes me want to go brush my teeth right now just thinking about it. All right. So that's the end of my presentation. It's time to get the band back together. We're going to bring everybody back up, and I'm going to shut off my screen share. Ladies and gentlemen, thanks for your time. I hope you had a good time. I'm going to be posting some links into the chat box in just a moment once I stop sharing my screen, and it's going to be downloadables of some of the graphs that I've given you. If you need anything else from me, please feel free to email me at brian@paterealty.com. By the way, remember that you are a realtor, not a realtor, okay? I was on WRAL last week and met with the girl and explained to her over and over again, it's realtor, realtor, realtor. And then she broadcasted on the story. She says, realtor Brian Pate. I'm like, okay, surrender. But just remember, know what you're doing. Become more knowledgeable. Just because you're only required to take 8 hours of CE every year doesn't mean that you shouldn't be in as many classes as you can. Thank you for taking your time out to listen to me today, and I am finished running my mouth. So I will stop my share here. I will turn it back over to the lovely and talented Nicole Walker. Make host.
So,
all right, it's all yours, girl.
Thank you. Guys, don't go anywhere too fast. Remember, we are having a competition. So thank you, Brian. If you will scan this QR code, it will take you to a raffle sign up. Sign up for the raffle. Take a picture of your screen. Post one of these graphics from Brian. Post something that you learned, but post something. So sign up for the raffle. Post something. Tag all of us. I know it's a lot of tags, but your algorithms will love you for it. Just do it. Tag all of us. And we will do a raffle. Right after this, I'm going to do a live raffle on my Instagram, and I will tag all of these lovely folks in it as well. And we're going to do a $50 Amazon gift card. Also, a great point from Brian that he brought up: if you are out there posting on social media about new construction, great for you. I'm so happy. You should be doing it. Some of my best posts are home tours. My reels with Arielle sometimes get 4,000 to 8,000 views when we do home tours. However, Brian reminds us, you have to have permission to market a property. You are a licensed real estate agent. You have to do that. You need that in writing, or right now you have a really nice recorded call with True Homes telling you that you can go ahead and do that with our properties. All that we ask is that you tag us and that the information is accurate. And please don't highlight the fact that somebody left a soda can in an active construction site. We try our best to be as clean as we can, but let's try to be nice to the people that you are getting your social content from across the board. So anyways, guys, this is it for us. We are going to open it up. You can unmute yourself. I'm going to stop sharing and we'll do Q&A. So I know we went a little over, but if you'd like to stay and let me see here. Am I still sharing, guys?
Yeah, Nicole, actually, if you want to leave it up, that'd be great. So everyone has those social media handles. I think that would be helpful.
Right. And do we need to go back to the raffle QR code, guys?
I put the link to the QR code or the website link in the chat. So I know, Chris, you're on your phone and can't scan the QR code. So if you need just the link or you're on your computer or something, that's in the chat for you.
All right, so the way that we'll do questions is you can either, let's actually do it this way. If you have a question, put your name in the box and we'll go in a line. So does anybody have any questions for any of us that you would like to ask us? Anybody in there, or did we do our jobs too good?
Nobody yet, but if you think of anything, let us know.
Yep.
I think one really cool point that we didn't really specifically go over, but okay, let's say you had clients that bought a home in 2020 or 2021 and their interest rate starts with a 2 or starts with a 3, and you're like, you know what, those clients, like, they're so happy with their house, there's no way they're gonna move because their payment is so low. That's not necessarily true. Keep in mind, like, there was at least 3 clients that I can specifically think of who came to me in 2020 or 2021 and said, Arielle, I want to buy this house. And I'm like, okay, great. What do you love about it? And they're like, absolutely nothing. We don't like the location. We don't like the size. We don't like the layout. We don't like anything about this house. They panic bought because they were afraid of missing out. They thought their landlord was going to sell their rental and kick them out, as well as a variety of other reasons. So when you're thinking about, the interest rates being higher than before, keep in mind, it doesn't all come down to money. There's a lot of reasons people move, and they might bite the bullet and pay more because they don't like the situation they got into in 2020 and 2021. So just a cool thing to keep in mind. Definitely with Brian talking about staying top of mind with those clients that you had in the past. Talk to them if they have a high interest rate about refinancing with Melissa or Alex. Talk to them how they like or maybe don't like their home that they bought in 2020 or 2021. Maybe there's a better solution out there for them. Still no questions in the chat, so I think we did a pretty good job for today.
I'm just going to add a couple of points, Arielle, to what you just said before we sign off. I think that's very impactful. 2 main things. True Home's got a full hour of coaching all of our salespeople with Jeff Schwartz. If you don't know who Jeff Schwartz is, he is very specific to new construction, but the information that he shares, I found to be impactful to all of you guys. Hopefully we'll be rolling out some information on that as well, but go look him up. The number 2, like top 2 things that he shared with us. Number 1, be kind. You will get more business this year simply by being a nice person compared to everybody else. So be kind. Second, if you ask them where they're moving from, like what is their housing situation and why they are moving, you will get all of the rest of the information that you need. People will give it all to you. So focus, like hyper focus on where they are currently and where they're coming from. Also, I just wanted to share, we really appreciate you guys. I said we would mention our core broker program. That is a program where you and your clients get special incentives for doing repeat business with us. If you are a core broker, we love you and we want to keep working with you. If you're not one, get with me and Arielle and we'll tell you how to get on that track. That's it for us, guys. So thank you to our partners, Brian, Alex, Melissa. We really appreciate you. And we are here to support you guys. So thanks.
Thank you. Thank you, guys.
Thanks, everyone. Have a great rest of your day.